Hello, everybody, and welcome to the Silver Log. The month of May is now over as we enter June. And despite having a vicious down cycle to start the month, it was still the third highest average price for the month in the history of silver. Now, as far as the action for today is concerned, the price of silver was up 1%. Gold down about a quarter of a percent, which doesn't really mean too much. In fact, what it's telling us is the volatility is really not there. For silver, the price movements was about 2% top to bottom, which is really, really light. And for gold, going from about 1533 to about 41, that's about a half of a percent from top to bottom, not volatile whatsoever. And as far as the volatility is concerned, the objective to this 0.5% level, it has been reached as it found resistance towards in here where we had support. Now the moves means that on a hourly level, that with a price of about $38 an ounce, it's usually going to be about 19 cents of a move from the highest point to the lowest point on average. All right, now let's move on to the monthly chart. As I've been stating, the month is over, and we are now moving into the month of June. And within this chart, the lines on the screen represent significant Fibonacci levels. I've already covered this in depth before, so I'm not going to go over it again. However, this move down this month is close to in here where you can say, yeah, that's support. Almost like saying this resistance point is close enough to in here, which is why when it broke through it, it broke through pretty convincingly, but in reality, it didn't break through convincingly back here because it had many months where it was resisted at roughly the $19 level. Therefore, a lot of times you want to see resistance in the past become support in the future. Thus, this resistance has now been support. If we break or when we break above this level, will we see $50 become support at some point? I'd say maybe or possibly. However, wait and see what the message of the market will bring us. We still have an amazing uptrend, even though we've had the volatile moves. It's found support in here at this level of resistance. Same with this in here. And because we've had a few tests of this 50, or we've at least tested within this chart, a move back up to this level will increase the chances of taking it out. Now we'll look at the shorter term time frames. We'll now move this on to the daily chart, and I've been stating how boring this market really is as long as it's trading within this range. And the moves over the last few days have been extremely light. This is what a 2% move looks like. It's below the 50-day moving average, which is pretty much flat. It is rising right now, but for the most part, it is flat. This volume weighted average price from the August breakout, again, it's flat. And Fibonacci lines are always flat, at least for the most part. And support here on now two occasions. It's lifting off from this area so far. Again, if it doesn't get above this level, comes back towards here with the rally on extremely low volatility, you'd have to think that it could have a fast move going lower. I don't think that's going to happen, but on the if scenario, that's why I'd want to point this out. We'll now keep the daily chart, but take a look at more candles. And within this, we can see again that it's had a nice hold here at this level, a rising 200-day moving average. And pretty much as long as we stay within this, it'll be boring. But if, of course, it gets above this 50-day moving average with little to no resistance, we move up here, maybe do something like that. then this would be a pretty large size fast move that would give us a price objective up towards the 60 area. That's really jumping the gun right now, but something to keep in mind because failed moves can often create fast moves, and the bigger the failure, the bigger the fast move probably will be. Sort of like how a break below here, this was that failed move, and then that created the fast move above. The volume just lightening up, and we're now back to the volume that we encountered back in February, March, December. It's pretty much in the area of like 40 million ounces or 40 million shares, I guess, per day, because this is all within the paper contracts. Now let's switch this up to the hourly chart, and what we will see here, let me just find it because there we are. The hourly chart, we are seeing within this Fibonacci level, found resistance immediately, and it's back there again. And the movement it's taken to go from 32 to 39 has been shorter than it was before. If we draw a straight line from point A to point B and match it in within this bottom, then obviously it's not as large as an uptrend as we had the first time. That's because it was a dead cat bounce from this massive selling that took place. However, this running average since the start of the market crash was not resistance, rather, it was support. And within Fibonacci, I've said this quite some time, and it's really any resistance point for that matter. When you come up to an area you're supposed to, and you pull back and make this higher low, like was encountered in here, and then you're showing this type of pattern, it's now giving breakout signs that it wants to get above this Fibonacci, which would thus make the status of this market go from bearish into the neutrality state, since this move, which goes down towards this level in here. The 50-day moving average, again, it's a pretty massive level, and if it finds resistance there and comes back and finds support in here, that would be very ideal. A move where it just trades up, maybe, and that maybe goes on a range-bound market where it finds support in here, then that would work out fairly nice. Also, we look at this, we can see that this previous level of resistance was used as support in here. No reason why the market can't go higher because it's up too much. The answer is it is not up too much. On the shorter term for the same chart, using the Fibonacci from this high and this low, managed to find resistance in here, and again on the breakout, and that's what I said in yesterday's video, was that it was showing like liftoff support. I mentioned the level 3802 or 38 as support, which pretty much is exactly what happened. It came right back down to this 38 level, right in here, and even close into this part here. And also, another thing to notice is that of a bear trap. You can see this little move here went below the 1-day moving average, and it didn't confirm the move breaking below there because you had this down candle that broke it. This was not a confirmation candle, didn't mean that it was going to go higher, just that when you see this move towards here, it's looking more and more as if that was a failed move. Now that's not that big of a failure, so you don't expect that big of a fast move, maybe even just back to the 39 level, testing previous resistance. If we draw a trend line to connect the lows within this market, or the uptrend rise, let's see the best one we could find right in here. We can see the same thing here. There was this many levels that was support, had that pierce below it, wasn't able to hold. The bears could not take any control over the market, and now of course it looks as if it can come up and test this level, because what I like about the Fibonacci is when you get above the 61.8%, you'd want to show something to confirm a breakout pattern, which really has been the case. It seems very optimistic. I don't like that word. Probable or extremely probable that we come up and test this level rather than breaking below in here. However, the 5-day moving average has not been tested yet within this bull market, intermediate bull market that is. This is a 5-day moving average. The first time it comes to that level, whether it's on a reduction with the price going lower or whether it just continues to correct through time, it's a likely area where the market is going to bounce from. If the market continues trading sideways for a few days, then the 5-day moving average would meet up with it. The 50-day moving average is rising, as we can see a little bit better on this chart. The reason why it's rising is because the price of silver is higher than it was 50 days ago. If the price of silver was $34, $35 then, and now it's 38, what you're doing is you're replacing on the moving average number a 35 with a 38. That would make it go higher. If 50 days ago it was 43, then it would be going lower, and if 50 days ago it was 38, then it would be staying sideways within the way it moves. Okay, next chart we're going to look at is the direction from the 50-day high and 50-day low. Before I was stating in here on the break of 10%, it was good long plays. That really wasn't the case in here because this level is above this level. Therefore, it still shows that the sellers would still be in control. And again, why you'd want to see the market go above the 50-day moving average. If you're buying bullion because it's really cheap now or you're unsure, I think that's a totally good play. However, if you're looking for some confirmation, what I want to see is this line go above this line and establish some sort of level of support, maybe even around 20%. I'll get back towards that. However, because we are what this means is that we are closer to the lows than we are with the highs because this is higher than this one. Final chart will be an inflation adjusted chart, and this is it. Not much to say about this. I've talked about this before. Obviously, we were getting crushed for so many years. We're close to the highs of 1980, but inflation adjusted, not really all that close at all. The great buying opportunity was in here. It pretty much still is, just not as good. If you're waiting for a pullback, it's tough to say when that's going to take place. Yes, it's went from 50 down here, but that's not that big of a pullback because the last significant resistance level is upwards in this 20 level. It's very far from the 5 and the 10-year moving average. It could still continue to go higher, sort of like it did in here, even though it's been up a while. It can still continue to go to the upside. Obviously, we've already seen the correction shorter term, and that gives me some optimism for the markets to go higher. Final point, I want to talk about some technical indicators, automated trading, because the significant level was to buy on the breakout here because of these moving averages. You had a break above it, and then you found support after a previous declining set of moving averages. This allowed the moving averages to flatten out and go higher. You broke a significant resistance point, so there's a good entry point. And finding entry and exit points, it's a huge skill, and I don't know of any mathematical formulas that can make it so easy that a computer pretty much can trade for you, or you just stick with a numbers game. Once a certain parameter comes into play, you're going to go long, you're going to go short, you're going to sell, you're going to cover, all that type of stuff. Because what I've gotten here is the stochastics. This is, whatever this means, 18% K3. That's how Free Stock Charts has it written. And the way it's set up with these is you want to sell when the stochastics are at 80, and you want to buy when they're at 20. Therefore, by waiting for the market to go below 20 to buy, this is how you do. For the monthly time frame, A purchase on October of 96 at 41, you sell it at 683. Then you buy back at 493. Hey, that worked out pretty good. And then you sell at 515. But now you're buying at 976, so you're buying a lot higher. Then you sold it for in here, and then you sell it in April for 1861, and you're still holding cash because you're patiently waiting for the stochastics to move to 20. And a situation where if say the market's going up really, really high and then you sell and you're trying to wait for 20, if the market keeps going higher, you could be waiting a long time to get your order. And you can also have some big losses, which we'll see in here. The 9-day chart. December, and yeah, by the way, before we finish off this, if you would have made these trades on the monthly time frame, you would be at $13.64, thus well underperforming the price of silver, but still up though. On the 9-day chart, December 94, you buy at 470, then you sell at 597. You buy at 516, then you sell for a profit, then you buy it cheaper. That's going good. You sell and then you buy cheaper again, and well, you sell for a loss, but at least you buy back cheaper, so it's all working out good again. You sell at 566, and here we go again. You're waiting for the stochastics to go to 20, yet you had to wait for the market to go all the way up to 20 and then have a significant crash. You sell in September '09 at 1574. You're still waiting for the stochastics to go down to 20. It has not. 1343, same as before. You're doing well, but you are underperforming the metal. Weekly time frame. Same sort of deal here. You're buying at 442, and the big reason again why you're well underperforming the market is when you buy at 1653, sell at 1308, then you buy in February of 10, sell in April of 2010, and again you're waiting to get back into the market because it hasn't went under 20 yet. On the daily chart, same sort of deal here. You're at 2248, therefore underperforming the market starting at 1633. And let's see what the big loss on this one was. Well, when you buy at 1786, July of 2010, sell in August, you don't get back in the market until 2886 before the market corrected in January. That means when the market had this major uprise in here, you never got in because you were waiting for the correction. That's what so many people have been doing. Oh, I want to see a pullback. I want to see a pullback. Sometimes you can get in on that, and a lot of times you will get that pullback, but that could also mean that instead of buying on strength on the breakout at 22, you're buying on 28. However, the stochastic said in February of 07 to sell at 29.34, and then again to buy at a much higher price May the 5th. You had to wait for the market to go from 50 to 34, and you would still be in your long position. 15-minute time frame. Not going to go over too much other than I'm using the SLV. Had you been doing it this way, you'd be underperforming the market because you'd be down 49 cents from what the actual close happens to be. Alrighty then, thank you for watching this video and have yourself a magnificent month of June. Take care.